Hey guys, today we'll be looking at a question from the 1996 Berkshire Hathaway Annual Conference on how many stocks you should own in your portfolio. It's a common question from investors, so let's get into it.
My name is Mark Hake. I'm from Scottsdale, Arizona, and I'm very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practice generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
Warren touched on a few things here. First, he mentions the difficulty larger investors like Berkshire Hathaway have in buying stock in smaller companies. He mentions the stock price of these smaller companies can move quickly when he makes an investment. This is because a lot of investors follow Warren Buffett, so as soon as it becomes public news, a lot of others rush in as well. And with extra demand for something, the price often follows. Now, smaller companies often have lower liquidity, which explains the ease of buying into or selling out of an investment. So if you have a smaller company and there's a lot of people wanting to buy the stock, the price will rise really quickly as there's not enough liquidity to go around. On the other hand, if you have a larger company that has a lot more liquidity, it's easier to make large investments, as Berkshire often does. Another issue that he didn't mention during the response is one of materiality. Berkshire Hathaway is worth nearly $1 trillion. So 0.1% of their capital represents $1 billion. Now, to purchase $1 billion of stock in smaller companies would not go unnoticed by the market. This could potentially cause the stock to surge as market analysts notice a whale or large investor taking such a position. The same applies in reverse when trying to sell. Moreover, even if the position doubled in value, it wouldn't be material to the overall value of Berkshire. As retail investors, we have a chance to find opportunities in the market that larger investors like Buffett can no longer enter. They are restricted to larger companies that are A, worth Buffett's time, and B, can handle the amount he tends to invest. The second thing that Buffett mentions about diversification is being a protection against ignorance. He goes on to say that it's only good for those who don't know how to analyze a business. Now, this isn't meant to be an insult, as Buffett is a huge advocate for low-cost index investing. However, this view is in the context of a layman who hasn't got all day to research stocks. Buffett has spent a lifetime researching stocks in more detail than any reasonable person can that holds down a full-time job. So diversification is a defensive strategy for those who don't know or don't have the time to analyze companies. For this group, broad diversification such as low-cost index fund investing is a safer choice.
If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. Because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well.
Buffett continues on from his earlier comments here. He makes the case that it's better to invest in a couple businesses that you know extremely well than to invest across 30 to 50 you are moderately well versed in. In recent years, there have been many retail investors that have heavily invested into Tesla or Nvidia's stock, or even Bitcoin, reading into every single thing that's published about them. This is the level of expertise Buffett expects investors to have when going for this strategy. If you don't have the time or expertise, it's better to settle for a market return through low-cost index funds like the S&P 500.
And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it, and the truth is you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean. There is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses.
Here Buffett describes what he's looking for in a great business. Often, it's called an economic moat. This term encompasses all the factors that protect the business from competitors stealing market share. Coke, for example, has one of the greatest moats of any business.
Coca-Cola stock, as you know, we've never sold a share. And I wouldn't think of selling a share. If you're looking for a wonderful business, it was hard to beat Coca-Cola.
They have extremely strong retail partners, global presence, enormous economies of scale and vertical integration, and customers are extremely loyal. I even saw that Costco in the United States is now switching from Pepsi to Coca-Cola. And we've seen this with KFC here in New Zealand as well. So Coca-Cola is globally dominant in that cola space. The specific things that Buffett has really liked about Coca-Cola in its economic moat is its simple business model and its strong cash generation, irrespective of economic conditions. So when Buffett advocates for investing in a couple great businesses over a lifetime, he is talking about such businesses with a strong economic moat. Simply prioritize quality over quantity of businesses.
And it's amazing what has been taught over the years in finance classes about that, but I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and yeah, it's
It has no utility. I mean, it will tell you how to do average, but I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues, but there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. Something very strange is going on.
Here we see the pair criticize corporate finance courses for overcomplicating investing. Now, I've sat in a few such cases at university, as well as one on value investing. And you know what? It's very true. They bog down finance into mathematical formulas to approximate portfolio risk. Here is the modern portfolio theory they're talking about. It argues that adding stocks to a portfolio should not be viewed in isolation, but rather by how it affects a portfolio's overall return and risk. Theoretically, we can add stocks to a portfolio that result in greater returns without adding greater risk based on their correlation to existing positions. Buffett and Munger say to ignore the academic theory and simplify the process by just picking great businesses that are well understood. Invest in what you know and ignore the unnecessary complexity.
If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Here we see the pair of them reinforce the philosophy that great investing doesn't require complicated formulas, but instead it's about understanding great businesses. For retail investors, it's an endorsement of simplicity and not overthinking. The last line from Munger is a stab at how academic institutions try to overcomplicate the topic, as the topic of value investing could be taught in just a week. And to be fair, these guys are certainly the greatest investors of our lifetime, so they certainly know their stuff.
Yeah, and the high priest wouldn't have any edge over the lay people, and that never sells well.
Right.
Buffett, of course, wraps up by emphasizing that successful investing doesn't require complex strategies. Focus on the basics, invest in quality, and if you know how to analyze businesses well, ignore the overcomplicated academic theories. I enjoyed this Q&A answer from Buffett and Munger. We shouldn't make the mistake of them downplaying diversification, as it needs to be looked at in context. These guys have spent a lifetime researching stocks, finding the absolute cream of the crop among the 6,000 plus listed companies in America. So for them, they have observed some companies over several decades and often spend months with their investment team scouring every piece of knowledge on a company. Those of us with other commitments outside of investing would find it difficult getting to the level of understanding they'd expect before making an investment. So in that context, they'd be a strong advocate for a layman to invest in a broad-based market index and get a fairly average market return. Let's not forget that Buffett owns a large share of broadly diversified SPY units and has often advocated for them in the context of retail investing. If you like this video, check out some of the others that I've made somewhere over here. Before you leave, make sure to hit the subscribe button, and I look forward to catching you on the next one. Cheers.